Tenemos como invitado también con nosotros a Jay Pelosky. Jay, ¿qué tal?
Jose, nice to see you. Thank you very much.
Thank you for having this time with us.
Yes.
What do you think about Fed decision? What do you think about the stock market, the stocks, when they know if they are not divided, split,
Yes.
completely?
I mean, I think the market expects a 25 basis point cut, and that's what the market's going to get today. We'll see what the voting is, right? And I think more important than that is going to be the dot plot, the summary of economic projections, right? The market wants to look forward and wants to get a sense of what's coming down the road. What's happens today is already in the price. And the action, I think, is not at the short end, it's at the long end, right? Where the 10-year bond is, the yield is rising, right? And that is not just an American thing, that's a global thing, right? The bonds, the JGBs in Japan, because governments are spending.
We are in global height, global bond height of since 29.
Yeah, 15 years, right, since the
more than 15
financial
years.
crisis, right.
It's
And there's a reason for that, and the reason is very simple, right? We have governments around the world spending to compete in AI, in defense, and in climate. So it's what we call fiscal age, right? And so as governments spend, bond market gets a little nervous and says, okay, you need to pay us more, you know, for us to take that risk of inflation going up with that spending. So that's where I think we are, and therefore, as an investor, you know, we're underweight bonds, right, and overweight things that will do well in growth, like commodities.
Maybe it's the last time when in the next couple of years, or in the next year, when Federal Reserve could reduce the interest rates, because we have the labor market in 4.4, we have the inflation in 3%, is 1 point up.
Above the target, yes, let's remember.
It's very difficult, it's very complicated to explain to the investor that this is an option now.
Well, I think the investors are okay with that, as long as there's growth, right? Remember, from a stock market perspective, the only thing that really matters is earnings. And earnings tend to be higher when you have a little inflation. And so next year, the forecast is for the S&P to grow earnings about 10 to 12%. As long as that's maintained and inflation stays around that 3% level, I think markets are going to be fine. And if inflation creeps up, and if there's some politicalization of the Fed, right, with the new Fed chair, then I think you watch that 10-year bond. And if it goes above 475, close to 5, then I think stocks probably have a problem.
Because there are a problem with prices. For example, the next chairman of Federal Reserve, he needs, or she needs to start the debate around 3% and not 2% of the objective of the Federal Reserve, because this is maybe a solution very easy for Trump to resolve this situation. Maybe the 2% is too low.
Well, and I think for sure the Trump administration's made it quite clear it wants to run the economy hot, right? Not only in terms of encouraging the Fed to lower rates, but also running a very big budget deficit, right? We have in the U.S. a 6-7% budget deficit. We have the Fed cutting into an expanding economy. That is the definition of run hot. And again, investors are fine with that as long as inflation doesn't get out of control. So that's why I'm saying what we're watching is inflation and where the long end, the 10-year bond yield goes. The 10-year is much more important as a signal about how the market thinks about inflation than the front end of the Treasury curve.
Do you think that we have a debt problem in this moment with the United States, with the global debt from the different states and for companies? Because if you see the offer to Warner Bros., you see $58 billion in debt. This is a lot of money. We are starting a new global debt area.
Well, I think we already are in that, right? As we said, we call it a fiscal
But
age.
could be a problem?
I don't think it's certainly not a problem on the corporate side, right? Corporate credit, I think, is doing fine. The idea that the Magnificent Seven or the hyperscalers are going to have a problem, I think, is completely off base, right? They're completely unlevered companies. They're A-rated, they're investment-grade companies, very different from the dot-com era. So I think corporate is fine. I think government, as I said, governments around the world are spending to compete in AI, defense, and climate. And so what I think comes next is the revenue side. So I think we're going to hear a lot more about taxing, a lot more about taxation of the wealthy who have made a tremendous amount of money the last 10 or 15 years.
And that could be a problem for investors.
Well, it could be a problem for investors. And I think the way we look at it is it's probably more a problem for the United States, because we think the next step is that governments are going to start to tell their pension funds and their big institutions to keep the money at home, to help the domestic government build out these issues on AI and defense. And we already see it in the UK and Japan, where they're saying to the pensions, hey, you need to invest more at home. And so Europe, for example, exports about $500 billion a year in capital, most of it to the United States. And now the US is telling the Europeans, hey, you guys are on your own. What happens if the Europeans turn around and say, hey, we're not going to fund you anymore? Then the 10-year goes to 6, the dollar collapses, and markets have a real problem. I'm not saying that's necessarily a real possibility, but I do think the issue of taxation, revenue generation, as opposed to just spending, is going to be where the debate goes in the next couple of years.
I think that, do you think that there are not a bubble in the artificial intelligence for you, for your words, but
no, not at all.
Maybe it's overvalued?
Not really, no. I mean, I think if you look at Nvidia, okay, as the poster child for AI, Nvidia today, on a forward PE basis, trades at a 20 to 30% discount to the average of the last 3 years. Okay, so that's the leading company that's trading at a 25% discount to its valuation over the last 3 years. So no, I don't think AI is in a bubble. I do think there's increasing competition between the US and China in tech and in AI. And so as we see it, we like the technology sector in China more than we do the technology sector in the US. Tech in China trades at about a 50% discount to tech in the United States. And increasingly, the Chinese tech stack and the US tech stack are completely separate. So as a global investor, we think you need to have positions in both. And then we really like the idea of connectivity all the way from the commodities that are needed. We say that AI, the digital, eats the physical. So copper, silicon, water, semiconductor chips, electric grid, and onward. That's the way we're looking at this entire space. We think there's tremendous opportunity, and around the world, not just in the US or in China.
And what do you think about the role for Europe in this area? Because Jamie Dimon, JP Morgan, they said this weekend that maybe it's a problem for United States, not for Europe, only Europe, that Europe could be a bad moment in the next decade. And bureaucracy and all these things could be a problem for United States if the workmate is making bad work in the competition with China for the United States. The United States needs a very healthy Europe.
Well, that's what historically one would think, right? The current Trump administration in its new national security strategy document is pushing Europe away. And one wonders about the soundness of that idea, because to compete with China and its scale, even the U.S. needs allies and needs a bigger network. And so the idea of pushing Europe away, as the Trump administration is doing, doesn't really make sense from a strategic point of view, in my opinion. Now, Europe knows exactly what it needs to do, right? It needs to make a much better capital union, right? It needs to provide much more venture capital, like early startup capital potential. It needs to really leverage the single market, as opposed to having all these tariffs in the different countries that adds tremendous cost, right? Estimates of 50%, and basically an internal tariff of 50%, which is just crazy. So Europe knows what needs to happen, and my thinking is that given where the U.S. is and how the U.S. is treating Europe, the next couple of years, if Europe doesn't do some of these things in the next couple of years, then that's the fault of Europe, and it's not going to be a particularly great place to be. Right now, given the valuation, we like European banks, we like European defense sector, and we like the fact that Europe is on an early stage of a credit upcycle. And so we think growth in Europe is going to be fine next year, and so we have pretty healthy exposure there. We're more, in our global multi-asset model, we have much more invested in global equities outside the U.S. than we do inside the U.S. We're underweight the U.S., overweight the rest of the world, especially emerging markets and commodities. That's our positioning for 2026.
Only one thing more. 2026. This is the second year of the mandate of Donald Trump. Mm-hmm. It's not a good year historically. Mm-hmm. From -7
right.
to -46. Mm-hmm. What do you think? What's your outlook inside this revolution of the artificial intelligence? Could be an exception this second year, mm-hmm. and good news for investors, mm-hmm. and for Trump.
Mm-hmm. I think really, again, as we talked about a few minutes ago, it's all about the earnings, right? So when you look at 2026 earnings forecast, earnings are expected to grow about 10%. If you have 3% inflation, 1 to 2% growth, which we think is reasonable, that's 5% nominal growth. 5% nominal growth with some continued focus on AI and margin improvement gets you to earnings of around 8 to 10%. If you have earnings of 8 to 10%, stock market's probably going to do fine. Again, as I said, if the long end goes up towards 5%, stocks are not going to do very well. And importantly, it's really important to understand that for the non-U.S. equities to do well, right? Our positioning, our thesis is non-U.S. outperforms. It did in 2025. We think it will in 2026. We think we're at the beginning of a period of multi-year where non-U.S. outperforms the U.S. And so the best environment for that is when the U.S. just kind of meanders along, right? If the S&P's up 20%, nobody cares about non-U.S. If the S&P's down 20%, everybody sells everything. So we expect the U.S. next year, single digit, 5 to 10% return on the S&P, non-U.S. equities, 10 to 15%, commodities, particularly energy, number. 10 to 15% upside.
But it's a big number because we are continuing 2 years of double digit, more or less 50% up. This could be a good number for investors.
Yeah, well, again,
if you see the past.
Right,
3 years. But yes,
we're more focused on the forward and on the earnings, and earnings outside the U.S. also. Example for you talked about Europe. European earnings next year are expected to grow 10 to 12%. If that again happens, then Europe is cheap, right? If you're going to get the same earnings growth in the U.S. and in Europe, but Europe sells at a 40% discount to the U.S., then you should be buying Europe. It's very simple.
Thank you very much.
Jose, nice to see you.
Thank you for coming with us
it's a pleasure.
the stock market.
It's a pleasure. Thank you.
In Nice and Wall Street.
Thank you.
Thank you.